Well, stocks seem poised for a record high. At least they did until the latest Philly Fed survey blew the steam right off Wall Street. The survey's weak numbers again raised the specter of a hard instead of a soft landing for the U.S. economy, and that sent a lot of investors running for the hills. Michael Darda is the chief economist with MKM Partners. He's not too worried about the economy at all, but Peter Schiff is the president of Euro-Pacific Capital. He says, forget about a hard landing. We are looking more at a crash landing instead. Peter, the numbers have been going your way lately, so why don't you kick it off? What do you see?
Well, you know, the reason that I'm in this crash landing camp, and I realize that I'm probably there alone right now, but I think the economy is going to be a lot weaker than people think. But despite the weakening economy, I think inflation is going to be a lot worse. And as a result, you're going to have the Federal Reserve raising interest rates into the recession, which is only going to exacerbate the problems and exacerbate the flight from the dollar, which is really what's going to be driving the inflation rates higher and sending interest rates much higher, particularly on long-term instruments. And when you have an economy so highly leveraged, not only the individuals with all the adjustable rate mortgages, but when you have a federal government with a $9 trillion debt financed with Treasury bills, when they have to roll over a third of that debt in the next year, our whole economy is vulnerable to the higher interest rates that foreigners are going to be demanding for holding U.S. debt.
Okay, that is a lot to consider, Michael, but you're much more positive about all of this. What do you make, even despite this weakness that we've been seeing the last couple of weeks?
Well, there have been some anecdotal signs of slowing, Becky, but really in the last 35 years, we've never had a recession with real short-term rates at current levels. And if you look at credit spreads, they're still fairly narrow, both suggesting that we'll probably see real growth in the 3s and nominal demand in the 6s. That's certainly not consistent with recession, so I just don't see it. I think back half of this year, growth is going to be 3 to 3.5% in real terms, although I would tend to agree more with Peter on inflation. I think the bond market now is drunk with rate cut optimism, and I just don't see the Fed as being able to start lowering rates. Financial conditions are not tight today like they were before the last two recessions. And I think inflation will be more of a problem, certainly than the bond market expects and a lot of other economists expect, and that's going to keep the Fed from lowering rates.
See, the big problem with historical comparisons is you ignore the unprecedented stock market bubble followed by a housing bubble that we hadn't experienced in the past. You know, we've still never resolved the imbalances from the stock market bubble. Greenspan and the guys at the Fed blew up a much bigger bubble in the real estate market, and so we've been postponing the pain. But unfortunately, now that the air is finally deflating from the housing bubble, I don't think there's another bubble that the Fed can blow up to push this out for another few years. So we're going to see a huge price to pay for both those bubbles. Although
Peter Greenspan himself was speaking last night, he says it's really too soon to tell if the consumer's been affected by the equity withdrawal from mortgages.
Well, remember, Greenspan has myopia when it comes to spotting bubbles. He couldn't spot the NASDAQ bubble. He didn't see the housing bubble.
Well, he talked about irrational exuberance before.
But that was in 1996. I mean, then he gave up. He didn't talk about irrational exuberance in 1999 or 2000. And remember, Greenspan was the guy that was out there encouraging people to take adjustable rate mortgages, talking about how much money they were saving by doing so. So I wouldn't look at his track record. It's abysmal.
Well, a lot of people would disagree with you on that. But, Michael, let's take a look at the February Fed Fund futures. They actually overnight jumped up to a 40% chance that we're going to see the Fed drop rates come next February. What do you make of that?
Well, I mean, if you look at the yield curve and the disposition of it, you have longer rates, well below shorter-term rates now, and usually the spread is about 100 basis points. So the bond market is thinking the Fed funds rate is going to eventually fall below 4% from 5.25%. I don't think we're going to be in a core inflation environment that's going to permit that. Our indicators still say that core inflation year-to-year rates are probably going above 3%. And unless we're in a very significant downturn/recession, the Fed's credibility would be blown if they start to cut rates into that environment. So I think the bond market valuations are very stretched. I disagree with Peter on the equity bubble thing. I mean, we had an equity bubble, and the valuations on stocks have corrected. We had excesses in real estate, and that's coming off now, but the Fed's on the sidelines waiting to see what the impact is and risking higher inflation to do it.
And there's no question that the Fed would like to cut rates, but yeah, they can't do it, and certainly our foreign creditors are not going to let them do it. And I think despite even the numbers that we're getting from the government on inflation, I think these numbers are understating it. I think inflation is already a much bigger problem than these bogus government numbers indicate.
Peter, I know you've been negative for some time. When do you think the market actually catches up to your views?
It's happening. The market's been going down in real terms for the past 6 years. Look at the price of Dow in terms of gold, in terms of oil, in terms of foreign currencies. We're losing value, but ultimately I think you're going to see a big nominal decline in the Dow, probably over the next couple of years. But the real decline, which is more important than the nominal numbers, is going to be a lot greater, because the dollar, I think, is going to lose the majority of its value, from where it is now. I think you can see the dollar lose 50% or more of its value relative to the euro, the Swiss franc, the yen, the Chinese yuan, or gold, or other commodities.
And Michael, you've been swimming upstream lately. When do you think you're going to be proven right?
Well, we'll see. I mean, we'll see how the data comes out. I think, we're still going to see respectable growth. But even if growth does slow, I think we're going to have a more persistent inflation problem, and that's going to prevent these expectations now being priced into the bond market from coming to fruition. I'd also say, on Peter's point, I mean, if the Fed's going to have to be hiking rates because of inflation, that's actually inconsistent with the big drop in the value of the dollar that he's predicting.
Well, no, it's not, because it's the drop in the value of the dollar that causes prices to rise, because foreigners will demand more dollars in exchange for their products.
And if the Fed tightens, it corrects that problem.
No, it doesn't. It's a higher interest rate is not.
If they're higher here than they are in Japan and Europe, the dollar will move up.
No, the nominal rates don't matter. It's real rates. And
they're higher here than they are in Japan and Europe.
No, they're not. Our inflation rates are higher. They're not. They're not higher. And, there are plenty of countries around the world that have very high rates of interest as their currency is collapsing. If you look at what the interest rates were, let's say, in the Asian economies during the Asian economic crisis, their interest rates went through the roof. They went to triple digits, but it didn't stop their currencies from toppling.
If monetary policy gets tight enough, the currencies will rise in value. It
no,
depends
it won't.
on what the equilibrium rate is.
There will be capital fleeing the U.S. because of the recession, because of all the defaults.
You've set up a situation where the way that you set it up, everything goes down no matter what.
Well, remember, they don't call me Dr. Doom for nothing.
Gentlemen, can we agree to disagree just for now? I'd love to have you both back on. This sounds like a debate that's going to be raging for quite some time. Guys, thank you both for coming on. We do appreciate it. Michael Darda again and Peter Schiff. Well, the market